The silver market is setting up for one of the most violent moves in precious metals history, and if you're not paying attention right now, you're about to watch one of the greatest wealth transfers of this decade happen without you. Let me show you something that should make your blood run cold. The silver market just entered its fifth consecutive year of supply deficit. Fifth consecutive year. That means for 5 straight years, the world has consumed more silver than it has produced. We're talking about 820 million ounces of deficit accumulated over this period. To put that in perspective, that's roughly 70% of annual global production just gone, vanished from available supply. And here's what makes this absolutely terrifying for anyone betting against silver. This isn't some temporary imbalance that's going to correct itself. This is a structural deficit driven by forces that are accelerating, not slowing down. Think about what a supply deficit actually means. Every single year, there's less silver available than the year before. The stockpiles are draining. The inventories are bleeding out. And unlike gold, which sits in vaults doing nothing, silver gets consumed. It gets used up in industrial applications where it can't be recovered. It's gone forever. Now, I want you to understand something crucial about how markets work. When you have a commodity in deficit, prices should rise to destroy demand or incentivize new supply. That's economics 101. But here's the problem. Silver demand is inelastic in its most important applications. You can't just stop using silver in solar panels because the price went up. You can't substitute it out of electronics without massive retooling costs. The industrial users are trapped. They need silver regardless of price. And the supply side? Even more trapped. Silver production is largely a byproduct of other mining operations. About 70% of silver comes from lead, zinc, and copper mines. You can't just turn on more silver production because the price is rising. You'd have to mine more base metals, which have their own supply constraints in economics. The silver market is structurally rigid on both sides. Let me paint you a picture of what's happening right now in the physical market. COMEX inventories, the registered silver available for delivery, have been in a steady decline. We're talking about the primary price-setting mechanism for global silver, and the vaults are draining. Every month, more silver leaves than enters. The commercial banks that used to hold massive short positions are quietly covering. The smart money is getting out of the way. Meanwhile, industrial demand is absolutely exploding. Solar panel production alone is consuming silver at a rate that would have seemed impossible just 5 years ago. Each solar panel requires about 20 grams of silver. Sounds small, right? But when you're producing hundreds of millions of panels per year, that adds up to hundreds of millions of ounces. And solar is just getting started. The global push toward renewable energy isn't slowing down, it's accelerating. But here's where it gets really interesting. Let me tell you about what happened in the 1970s. Because history doesn't repeat, but it sure as hell rhymes. In 1971, Nixon closed the gold window. The dollar was no longer backed by gold. What happened next? Gold went from $35 an ounce to $850 by 1980. A 24x move. But you know what did even better? Silver. Silver went from $1.50 to $50. A 33x move. Silver outperformed gold when the monetary system was in crisis. Now look at where we are today. We've got central banks around the world diversifying away from the dollar. The BRICS nations are building alternative payment systems. We've got record government debt levels. We've got inflation that's proving far stickier than anyone expected. We've got all the same monetary instability that drove the 1970s precious metals bull market, except this time it's on steroids. And here's the kicker. In the 1970s, silver wasn't an industrial metal the way it is today. Back then, it was primarily monetary and photographic. Today, silver is absolutely critical to the entire technology infrastructure of modern civilization. It's in your phone, your computer, your car, your solar panels, your medical equipment. The industrial demand floor that exists today didn't exist in the 1970s. So you've got the same monetary crisis dynamics that drove silver to $50 in 1980. Plus, you've got massive industrial demand that's only growing. Plus, you've got a structural supply deficit that's getting worse every year. You're stacking bullish catalyst on top of bullish catalyst on top of bullish catalyst. Let me tell you what the skeptics are missing. They look at silver, and they see a commodity that's been range-bound for years. They see failed breakouts. They see a market that's disappointed bulls over and over again, and they think this time won't be different. But they're not looking at the fundamentals. They're not seeing what's happening beneath the surface. The skeptics don't understand that silver has been artificially suppressed through paper markets. the COMEX trades more silver in a single day than exists in physical form in the entire exchange. Think about that. The price discovery mechanism is based on paper contracts, not physical metal. It's like setting the price of houses based on people trading house deeds back and forth without ever actually buying or selling real houses. It's absurd. But here's what happens when paper markets diverge too far from physical reality. They break. And when they break, the price adjustment is violent and sudden. We saw this in nickel a few years ago, when the London Metal Exchange had to halt trading because the paper market completely disconnected from physical reality. Prices went from $30,000 to $100,000 per ton in a matter of days. The paper shorts got absolutely destroyed. Silver is setting up for the same kind of break. The physical market is getting tighter and tighter while the paper market continues to pretend there's abundant supply. At some point, someone's going to stand for delivery on a COMEX contract, and the exchange isn't going to have the metal, or a major industrial user is going to panic about supply and start hoarding, or a sovereign wealth fund is going to decide they want physical silver as a strategic reserve. Any one of these catalysts could trigger a short squeeze that makes the GameStop situation look like a minor blip. Now, let me talk about something that most people completely overlook: the gold-to-silver ratio. Throughout history, this ratio has averaged around 15 to 1, meaning 15 ounces of silver equals 1 ounce of gold. Today, that ratio is sitting around 80 to 1. Silver is historically cheap relative to gold, absurdly cheap. When this ratio reverts to the mean, and it always does eventually, one of two things happens: either gold crashes or silver explodes. Given everything we know about monetary policy, government debt, and the industrial demand for silver, which scenario seems more likely? Gold isn't going to crash when central banks are buying it at record rates, which means silver has to rise dramatically. If silver just reverted to a 50 to 1 ratio with gold, we're talking about a 60% move from current levels. If it went back to the historical average of 15 to 1, we're talking about a 5x move. And that's just mean reversion. That's not even accounting for the supply deficit or the industrial demand explosion or the monetary crisis dynamics. Quick aside here, because this is important. If you're sitting on retirement accounts worth $100,000 or more, you need to understand how gold IRAs work. I put together a comprehensive guide that covers exactly how to get physical precious metals into your retirement account without triggering tax penalties. It's in the description below. This isn't about speculation. This is about protecting wealth you've already built. Worth checking out if you're in that situation. Anyway, back to what's about to happen in this market. Let me tell you about the lease rates, because this is where things get really spicy. Silver lease rates have been spiking to levels we haven't seen in years. When lease rates spike, it means there's a shortage of physical metal available to borrow. Banks and institutions that need silver for various purposes are willing to pay premium rates to get their hands on it. This is a classic sign of physical tightness in the market. And it's not just lease rates. Look at the premiums on physical silver coins and bars. Dealers are charging 30%, 40%, sometimes 50% premiums over spot price. That's not normal. That's not a healthy market. That's a market where physical demand is overwhelming available supply. The spot price on the COMEX might say silver is $25, but try actually buying physical silver at that price. You can't. The real price, the price where actual metal changes hands, is significantly higher. This disconnect between paper and physical is the powder keg, and every day it persists. More pressure builds. More industrial users get nervous about supply. More investors realize they can't actually get physical metal at spot prices. More shorts realize they might not be able to cover their positions if things get ugly. Let me tell you what's happening in China right now, because this is absolutely critical. China is the world's largest consumer of silver. They use it in electronics manufacturing, solar panels, 5G infrastructure, electric vehicles. Their demand is insatiable, and they're not buying paper silver on the COMEX. They're buying physical metal and taking delivery, tons and tons of it. Every month, silver flows from west to east, from COMEX vaults to Chinese warehouses. This is a one-way street. That metal isn't coming back. The Chinese understand something that Western investors are still figuring out. Silver is strategic. It's not just a commodity or an investment. It's a critical input for the entire technological infrastructure of the 21st century. Whoever controls the silver supply controls a choke point in the global economy, and China is quietly accumulating while Western investors are distracted by crypto and tech stocks. Now let's talk about what happens when the price really starts to move. Silver is a relatively small market. The entire above-ground supply of silver is worth maybe $1.5 trillion. That's less than Apple's market cap. It's a rounding error in global financial markets, which means when big money decides to move into silver, the price impact is enormous. Imagine if just 1% of global investment portfolios decided to allocate to physical silver. We're talking about trillions of dollars trying to squeeze into a market that produces maybe $25 billion worth of new supply per year. The math doesn't work. There isn't enough silver to satisfy that demand at current prices. Prices would have to rise dramatically to ration the available supply. And here's the thing. Once silver starts moving, it creates its own momentum. Investors who've been sitting on the sidelines see the price rising and they FOMO in. Industrial users who've been operating hand-to-mouth on inventory start panic buying to secure supply. Short sellers start covering their positions, which drives the price higher, which triggers more short covering. It becomes a self-reinforcing cycle. We saw this in 2011 when silver went from $18 to $49 in a matter of months. That move wasn't driven by fundamentals changing overnight. The fundamentals were building for years, but once the price started moving, the momentum became unstoppable. And here's the crucial point. The fundamentals today are far stronger than they were in 2011. The supply deficit is worse. The industrial demand is higher. The monetary instability is greater. If we get a move like 2011, there's no reason it stops at $49. That was the old all-time high. The next move could take silver to $75, $100, maybe higher. Let me tell you about the mining side of this equation, because it's absolutely critical. Silver mining is not profitable at current prices for many operations. The all-in sustaining costs for primary silver miners are often in the $18–22 range. With silver at $25, there's not much margin, and that's before you account for inflation in mining costs, which has been brutal. Labor costs are up, energy costs are up, equipment costs are up, environmental compliance costs are up. Everything that goes into mining silver is more expensive than it was a few years ago. What happens when an industry isn't profitable? Investment dries up, exploration stops, new projects don't get developed, existing mines get depleted and aren't replaced. We're setting up for a supply crunch that's going to take years to resolve even if prices rise significantly. You can't just flip a switch and produce more silver. It takes 7 to 10 years to bring a new mine online from discovery to production. The supply deficit we're experiencing today is going to persist for years, possibly decades. And here's something that should terrify anyone short silver. There's no strategic stockpile. Governments used to hold silver reserves. The U.S. government used to have billions of ounces. It's all gone. Sold off decades ago. There's no emergency supply that can be released to stabilize prices. When this market gets tight, there's no cavalry coming to save the shorts. Think about what happened with oil in 2008. Prices went from $70 to $147 in a matter of months because the market got tight and there was no spare capacity. Then think about what happened with natural gas in Europe recently. Prices went from $5 to $70 because supply got disrupted and there were no alternatives. Silver is setting up for the same kind of move. Tight supply, inelastic demand, no strategic reserves, and a paper market that's massively short. The skeptics will tell you that silver has been in deficit before and prices didn't explode. They'll point to years where the deficit existed but prices went nowhere. And they're right. But they're missing the crucial point. Deficits are cumulative. Every year of deficit drains the available stockpiles a little more. Eventually, you run out of inventory to draw down. Eventually, the market breaks. It's like a dam with a small leak. For years, the leak doesn't matter. The dam holds. But every day, the leak gets a little bigger. The structural integrity gets a little weaker. And then one day, without warning, the whole thing collapses. That's where we are with silver. Years of deficit have drained the stockpiles. The market structure is weakening. And we're approaching the breaking point. Let me tell you about what's happening with silver ETFs because this is fascinating. For years, silver ETFs were accumulating metal. Investors were buying shares, the ETFs were buying physical silver to back those shares, and inventories were growing. But recently, that's reversed. ETF holdings have been declining. Investors have been selling. And you know what that means? It means the smart money is moving from paper silver to physical silver. They're taking their metal out of the ETFs and putting it in private storage where they have direct ownership. Why would they do that? Because they don't trust the paper markets anymore. They've seen what happened with nickel. They've seen the COMEX change rules in the middle of the game to protect shorts. They've seen delivery delays and cash settlements instead of physical delivery. They want to own the actual metal, not a claim on metal that might not exist. This shift from paper to physical is incredibly bullish. It means the available supply for the paper markets is shrinking even faster than the production deficit would suggest. The COMEX and LBMA are losing metal to private hands. And once that metal goes into private storage, it's not coming back to market unless prices rise dramatically. Now let's talk about the elephant in the room: central bank digital currencies. Governments around the world are developing CBDCs. They want to digitize money, track every transaction, and have complete control over the monetary system. And you know what happens when governments have that level of control? People look for alternatives. They look for assets that can't be debased, can't be tracked, can't be confiscated. Gold and silver have been money for 5,000 years. They're the ultimate alternative to government-controlled currency. As CBDCs roll out and people realize what they've lost in terms of financial privacy and freedom, there's going to be a massive flight to precious metals. And silver, being more affordable than gold, is going to be the choice for the masses. Think about it. If you're an average person worried about government overreach and currency debasement, are you going to buy gold at 2,000 plus dollars per ounce or silver at 25? Silver is accessible, it's affordable. You can accumulate a meaningful position without being wealthy. That's why silver is called the people's money. And when the people wake up to what's happening with the monetary system, they're going to flood into silver. Let me tell you what keeps me up at night about this market. It's not whether silver is going to rise. The fundamentals are too strong. The supply deficit is too real. The industrial demand is too critical. Silver is going higher. The question is how violent the move is going to be and who's going to get caught on the wrong side. There are massive short positions in the silver market. Banks, hedge funds, and speculators who've been betting against silver for years. They've made money on that trade because silver has been range-bound. But they're playing with fire. Every day the supply deficit persists. Every day industrial demand grows. Every day physical inventories decline. Their position gets more dangerous. When this market breaks, and it will break, those shorts are going to scramble to cover, and there won't be enough physical silver available to cover all the short positions. Some of them are going to get absolutely destroyed. We're talking about potential losses that could bankrupt institutions. This isn't hyperbole. This is what happens when you short a commodity in structural deficit with inelastic demand. And here's the beautiful part. When the shorts start covering, they have to buy silver, which drives the price higher, which triggers more short covering, which drives the price even higher. It becomes a feedback loop, a short squeeze of epic proportions. And the higher the price goes, the more painful it becomes for anyone still short. The skeptics don't see this coming because they're looking at the wrong things. They're looking at the paper price. They're looking at technical charts. They're looking at sentiment indicators, but they're not looking at the physical market. They're not seeing the supply deficit. They're not understanding the industrial demand dynamics. They're not recognizing the monetary crisis that's unfolding. Let me give you a framework for thinking about this. There are 3 types of silver demand: industrial, investment, and monetary. Industrial demand is growing because of technology and green energy. Investment demand is growing because people are waking up to the supply deficit. And monetary demand is about to explode because the global monetary system is in crisis. When all 3 types of demand are rising simultaneously, while supply is in deficit, you get a perfect storm. You get a market that's fundamentally broken at current prices. You get a repricing event that's going to shock everyone who isn't paying attention. And here's what makes this even more explosive. Silver is leveraged to gold. When gold rises, silver rises more. When gold falls, silver falls more. It's a leveraged play on precious metals. So if gold goes on a run because of monetary instability, silver is going to absolutely explode. We could see moves of 10%, 15%, 20% in a single day. The volatility is going to be insane. Now, I want to address something that skeptics always bring up. But silver has disappointed bulls for years. Why is this time different? And it's a fair question. Silver has had false starts. It's broken out and then fallen back. It's frustrated investors who bought at the highs and watched their positions bleed for years. But here's why this time is different. The fundamentals have never been this strong. We've never had a 5-year supply deficit before. We've never had industrial demand at these levels before. We've never had this combination of monetary instability, supply constraints, and technological demand all hitting at the same time. The previous bull markets in silver were driven primarily by investment demand. In the 1970s, it was the Hunt brothers trying to corner the market. In 2011, it was investors fleeing the financial crisis. But today, we've got industrial demand that's structural and growing. Even if investment demand stays flat, the industrial deficit alone is enough to drive prices higher. And when investment demand kicks in on top of that, watch out. Let me tell you about what's happening in the electric vehicle market, because this is huge for silver. Every EV uses significantly more silver than a traditional car. We're talking about 25-50 grams per vehicle for the electrical systems, contacts, and conductors. Doesn't sound like much, right? But when you're producing millions of EVs per year, that's tens of millions of ounces of silver demand. And EV production is just getting started. We're in the early innings of the transition from internal combustion to electric. Over the next decade, hundreds of millions of vehicles are going to be produced. Each one needs silver. This is locked-in demand that's going to grow every single year. The automotive industry can't just decide to stop using silver because the price went up. They're committed to the technology. They're committed to the transition. They need the silver. Same thing with 5G infrastructure. Every 5G base station uses silver. Every smartphone uses silver. Every data center uses silver. The entire digital economy runs on silver. And as the digital economy grows, as more of the world comes online, as data consumption explodes, the demand for silver is going to grow with it. This is what the skeptics miss. They think of silver as just another commodity that goes up and down based on speculation. But silver is infrastructure. It's the foundation of modern technology. You can't have the digital economy without silver. You can't have renewable energy without silver. You can't have electric vehicles without silver. The demand is structural, not cyclical. And here's the kicker. There's no substitute. People have been trying to find alternatives to silver for decades. It's too expensive, they say. We need to find something cheaper. But they can't. Silver has unique properties that make it irreplaceable in many applications. It's the most conductive metal. It's the most reflective metal. It's antimicrobial. It's ductile and malleable. You can't just swap it out for copper or aluminum or some other cheaper metal without sacrificing performance. So the industrial users are trapped. They need silver. They can't substitute it. And there's not enough supply to meet demand. What do you think happens to the price? It has to rise. There's no other outcome. The only question is how high and how fast. Let me paint you a picture of what the next few years could look like. We're currently in the early stages of this bull market. Silver has been consolidating, building a base, frustrating the bulls. But underneath the surface, the fundamentals are getting stronger every day. The deficit is growing. The inventories are declining. The industrial demand is accelerating. At some point, probably sooner than most people expect, something is going to trigger the breakout. Maybe it's a major industrial user announcing they're having trouble securing supply. Maybe it's a COMEX delivery failure. Maybe it's a sovereign wealth fund announcing a major silver purchase. Maybe it's just the technical breakout that brings in momentum traders. The specific catalyst doesn't matter. What matters is that when it happens, the move is going to be explosive. We could see silver go from $25 to $35 in a matter of weeks, then from $35 to $50 as the momentum builds and the shorts start covering. Then from $50 to $75 as investment demand really kicks in and people realize this isn't just another false start. And then, who knows? $100? $150? When a market this small gets this much attention with fundamentals this strong, the price can go anywhere. The skeptics will be left behind. They'll watch in disbelief as silver does what it's been threatening to do for years. They'll kick themselves for not paying attention to the fundamentals. They'll try to chase the move and buy at higher prices. And they'll learn an expensive lesson about ignoring supply and demand dynamics. But here's what you need to understand. This isn't about getting rich quick. This is about recognizing a fundamental imbalance in a critical market and positioning yourself accordingly. This is about understanding that when supply and demand get this far out of whack, prices have to adjust. It's not speculation. It's not gambling. It's basic economics. The silver market is broken. The paper price doesn't reflect physical reality. The supply deficit is real and growing. The industrial demand is structural and accelerating. The monetary instability is creating safe haven demand, and the shorts are trapped in a position that's getting more dangerous every day. This is the setup. This is what happens before a market explodes. And if you're not paying attention, if you're listening to the skeptics who don't understand the fundamentals, you're going to miss one of the greatest opportunities in precious metals history. The smart money is accumulating. The industrial users are getting nervous. The shorts are getting squeezed. And the price is about to punish everyone who didn't see this coming. Silver is about to have its moment, and the skeptics are going to learn a very expensive lesson about ignoring reality.